Good morning. Good morning. Thank you all for joining us. We here at Harvested Financial are here to talk about the markets, and it is Thursday, January 7th, 2021. And we are looking at a big rally in the markets this morning. But before we go into that, I want to go through a couple different things. I want to talk about some brief disclosures first, and that's that all of the information, commentary, and opinions expressed on this or other websites or in any social media platforms or in any other media formats reflects the personal opinions, viewpoints, and interpretations of the employees providing such comments and are not considered to be a description of financial advice by Harvested Financial. The opinions expressed are for general informational purposes only and are not intended to provide specific investment advice or recommendations on any individual security. It is only intended to provide education about the financial industry. In no way is any content meant to convey investment advice, performance data, or any specific recommendation to buy or sell securities. We employ multiple methods of analysis and security selection to create client portfolios, which are not discussed in their entirety here. All the investments carry the risk of loss, and users should discuss any decisions with their financial advisor. Past performance is not a guarantee of future results. So, like I said, we are looking at the markets today here on Thursday, January 7th, and a bit of a rally overnight. So I'm seeing the SPY up $3.50, almost $3.40. That's almost a full percent, 90 basis points. Big rally overnight, trading almost 377 here. We are at all-time highs again. That's a common refrain we've heard. The other warrior leading the charge is IWM. So the Russell index is up also 93 basis points, $1.97, 206.5 for that. Qs actually really leading the charge here. Whoa, up 440 themselves, 140 basis points, trading at almost 312. So big rally in the markets. VIX is coming in. VIX is down $1.87, the cash VIX. So another day, another rally here. No coincidence, Bitcoin's also rising too. So rally across the board, no matter what assets you're holding, things are looking green today. But when things are looking green and things are sitting at an all-time high, you know what that is? That is a great time to start thinking about how to lock in your capital gains and how to lock in some of that appreciation. This goes really well for whether you're holding RSUs, GSUs, some type of employee stock compensation. If you have equity that was given to you as compensation, think about how you want to treat that. Is that an investment or is that a cash compensation bonus that you want to make sure to secure the value of? So that's a great example. I think we've talked about use cases where we also have inheritance stock. Don't want to sell that because of the capital gains implications. So lots of reasons to think about zero cost collars and no better time than when the market's at all-time highs. So I'm going to again talk about zero cost collars because that has been my theme of the week. So I'm going to share my trade hawk. And this time I'm going to look at a zero cost collar in Apple stock. So Apple is trading up about $2 today, trading around 129, higher than it was when I first set this up. So looking at our Apple stock, I'm going to go out about a quarter. So we're in January. We might think about the end of March. So think about how we want to handle this over the next 90 days. We actually don't have an expiration that's going to be truly 90 days. The March 19th serial expiration in Apple is only about 70 days away. But another really interesting name because it's a tech name. We're seeing a lot of call skew. So I'm going to show again how some of this risk reward profile can actually play in your favor with a zero cost collar. So to remind everyone, the purpose of a zero cost collar is to enter into a trade for zero cost that will put a collar around your equity position. So protecting your equity position on the downside, we fund this by selling calls on the upside. You're trading off some of that upside potential to gain that downside buffer protection. So what does this look like? Well, like I mentioned, Apple's trading a little under 129 right now. So I'm going to look at trying to find something that I can do for about zero cost. And if I buy this 122 put, I'm going to pay about $5.90. Stock's rallied a little bit more since I originally set this up, like I mentioned. But if I sell this 135 call, my net credit on the trade is actually going to be a couple cents. So I'm actually going to take in money on this trade. Assuming I can sell that for about $6 and pay only $5.90 there, midpoint's about a dime on this trade. So again, just to highlight where I'm looking here, I'm looking at the theoretical value on the 122 line. I have that as worth about 588. And then I'm looking at the theoretical value on this 135 line, which I have worth about $6. So let's take a minute to think about some of the risk reward here. And we're actually taking in a credit on this trade, but look at the downside. So if we're trading around 128 right now, we have $6 of downside potential. So 128 half all the way down to 122 half, it's about $6. But on the upside, we actually have $6.50 of upside. So while it doesn't sound like a lot of difference, that's an extra 50 cents that you get, and you're taking in money on this trade. So you can actually benefit from an uneven distribution of the put call prices here to take in a little bit of cash on this and still keep your upside. In many ways, if that is your employee stock, if that is your equity ownership, you would be very happy with an appreciation of $6.50 in Apple stock between now and March. So you might be bullish on that anyway. So, really interesting to think about the risk reward. And, another element that I'm going to highlight here is sort of what the vol skew looks like, and use this to demonstrate a little bit why some of these trade-offs and these imbalanced trade-offs can occur. True imbalance in the bullish direction. So I think that's actually a great play to think about. But this call skew is what I'm talking about here. And the way that just goes up. So, we do have the nadir here all the way down at around 128, right where we are, but quickly it picks up some value here. Quickly we're seeing that call skew starting to get bid. In a lot of ways, that's a function of demand for these call options. So we're seeing a lot of action coming for those call options. Typically, retail investors are buying these. It's been a really winning trade so far. So people are continuing to put their investments in buying upside calls, and that affords the seller of the call some interesting implied volatility opportunities to sell. So thinking about zero cost collars, there are tons of different ways to do them. You can think about different terms. You can think about different strikes. Do you want to give a very tight collar with only 1% or so on either side, or are you looking to give a much wider collar? How much risk tolerance do you have? Really depends on a personal situation. Harvested Financial, our strategies are customized for your individual situation. So when you're thinking about a zero cost collar, our tools will allow you to find exactly the right risk and reward trade-off that is going to make sense for your individual holdings. Tons of things to do here, whether it's Apple, whether it's Google, like we talked about yesterday, Microsoft's another great candidate, many zero cost collar options and opportunities in the market. So check us out, harvestedfinancial.com. You can mash the subscribe button. We're here every day doing Daily Bread. Next week, we're going to be rolling out a ton of new segments, all kinds of great content coming out of us. Education is so important for options trading, and we're here to help answer questions. So if you're tuning in live, we love hearing your questions. Again, mash the subscribe, follow us on Twitter at harvested_DAFE, because derivatives are for